When you own a capital asset, you have to track your adjusted basis in that asset. What does adjusted basis mean? Adjusted basis is the result of all the significant financial transactions related to that asset. The two most important transactions are the original purchase and the sale. There might also be some transactions in between that could affect the basis of that asset. Start with the price you paid for it. That price includes any fees, taxes, shipping, and installation costs that went along with the purchase. That price does not include any costs of financing that purchase. When we talk about the purchase price or the initial basis of a capital asset, we're treating that as if you paid cash. That's true whether it's a vehicle, a piece of equipment, a piece of real estate. You always set the initial purchase price or basis as if you paid cash. Any costs or fees related to financing are never considered part of the basis in that asset. Once you own and have acquired the asset, if you make any substantial changes, improvements, or additions to that asset, the cost of those improvements or additions are also added to the basis. Say you purchase that vehicle for $22,000. Now you add $1,000 of improvements to it. You put some new rims on it, or you put a new speaker system into it. So you initially paid $22,000 for the vehicle. You've made $1,000 worth of improvements. Now your basis in that vehicle is $23,000.